contains economic survey. It contains the financial results of the country over the past year. It contains budget estimates for revenue and expenditure for the forthcoming year. It also contains the surplus, the deficit, which the country will gonna have in the next year. It also contains the regulatory changes, sector-specific initiative, which the government will gonna have in the next 1 year. Most important, it contains the finance bill, which is more we're gonna talk about today. It's more about the Indian direct tax, indirect tax changes, how it will gonna affect the Indian foreign direct investment. That's what exactly contains in a budget, to be honest, from an Indian perspective. Now, what is the process? So most important things to us is finance budget, and finance budget is put down or put forward by the Indian Prime Minister. He put forward that to the Lok Sabha, which is the lower house of the parliament, and they suggest few comments on the budget. Then it will goes to the upper house, which is the Rajya Sabha, and they also suggest few comments or changes which they would like to put forward in the budget. It comes back to the Lok Sabha, and then they accept or reject the changes suggested by the other house of the parliament. Then finally, after the changes, it goes down to the president of the country for his final assent, and it becomes a bill. It becomes an act. So the whole process, I would say, it takes around 45 days to a 2 months period, where the whole finance budget becomes an act, and it will become applicable to each and every resident who's there in the country.
And so where are we in that process at the moment?
So as of now, it is being presented to both the houses of the parliament. So on 10th of July, it was presented to the first house. Then just this week, means yesterday, and it has been gone to the other house. And now after the changes, must be somebody writing down those changes right now, and then it will go to the president.
Okay, great. That's really useful. So the video is going to cut off, and we'll move to a few slides. I'll start off just by giving a bit of a recap. I'm aware that some of you are well versed with the Indian political scenario, but for those that are perhaps not, just a very quick recap. So in April and May of this year, India held its general election process, the world's largest ever election of its sort, and the BJP-led NDA delivered a substantial victory, and that's in the context of a country where growth rates had perhaps stagnated at a level below expectations, with some mild recession, where inflation levels were perhaps higher than would have been desired, and issues with bureaucracy and corruption, but also a feeling that a change was required. So it's in that context that the new government arrives, and they have just completed on the 10th of July their first budget. That's only 45 days after taking office. Now, you can imagine, therefore, that with such a strong performance in the general election, there was a great deal of hype before the budget in terms of what would be accomplished. And I think those, the sorts of areas that fell into, people expecting changes in taxation, people looking as to what the foreign investment environment would be like, and also looking at whether any decisions taken by the previous government would be reversed. So I think while some felt that the budget fell short of expectations, the reality is that so soon after taking office, our feeling, and we'll test this theory tonight, but our feeling is that there were a number of good directional signals which we expect to be built on over the coming months. So that's just a brief recap. What we're now going to do is I'm going to hand over to Kapil, who's going to take us through just the highlights of the budget, and then we'll drop into some more detailed sections. And as I said up front, please do submit your questions, which I will attempt to put to the panel as we go through. So I'll hand over to you, Kapil, to take us through the highlights.
Sure. Thank you, Ed. I would name this budget. Before even getting into the highlights, I would say it's a, as I pointed out in a highlight as well, but I would say it's a work in progress budget. As Edward said that, the government, the Prime Minister, the new minister, the whole the ministers of the new NDA government was given only 45 days to prepare for it. So it's a constant budget and the improvement which we're gonna see in future. So I would say it's a work in progress budget. When we were seeing the elections, when we were talking about the NDA government, when we were talking about the new Prime Minister Narendra Modi, one of his mantra, or one of the main prime objective which he was driving his election, that I will gonna make this as minimum government and maximum governance. That is what he belongs to. So he belongs to a state, Gujarat, where he did the same thing. So that is what the new finance budget is more about, the more governance in terms of the smaller and a bigger piece of the work wherever you go in the government authorities and the offices. So one of the key highlight, I would say another key highlight is subsidizes the subsidies targeted for the underprivileged. So they have really removed the subsidies which was given for the middle class. Now they are going towards the underprivileged. The government measures to be tax stable and investor friendly. They are talking now the old and the previous government, the faults or the processes which they've conducted, like a retrospective tax amendment, and they really talked about in the finance budget, though they couldn't do much about it. People know that it's a prejudiced case right now in front of a high court and the other courts in India, so they cannot reverse that position. But they can definitely form committees, which few of my panelists will going to talk about, is to how to affect that, how to win the confidence of the investor. Another highlight, I would say, the administrative and legislative reforms are the need of the hour. There is a movement towards the tax-friendly, the technology-friendly government. So the government is now moving toward the internet platform. You're going to see a lot of Indian website, the government website are keep on working now, even before the election and just after, the Indian Company House, the ROC website was not working for a month. And now they are investing good amount of money in the technology favored environment for the government employees as well. They have said to their employees, I want to see everybody in the office by 9 a.m. maximum. So, and they are going to teach their employees, the tax officers, that how to be tax friendly, how to be technology friendly. The focus in this budget is more on the infrastructure and creating more space for the public investment. Fiscal prudence to be the key agenda for the new government. I would say that the main focus of this budget is definitely to how do you reduce the deficit, which is what all the governments will going to talk about whenever the new government come about. But they want to increase, or they want to take the next step forward to take the Indian slow growth rate, which is still better than the Western world, 4.3, 4.7, but earlier it was going at 8%. So they're going to have two agendas, one to reduce the deficit in the current balance system which we have, and also to move towards the higher growth rate of 7 to 8% in next 3 to 4 years, which means it will come through new revenues, through disinvestment and tax collection. So those are the few key highlights, I would say, of the budget.
Okay, great. Thank you, Kapil. So as I said, now we're going to drop down a level. I'm actually going to pass it back to Kapil again. And he's going to just talk to us about the regulatory reforms that came out of the budget. So over to you, Kapil.
Thanks again, Ed. Generally, to be honest, regulatory reforms is something which is a sector, or which is an area which concern the foreign investors primarily. Changes in the foreign direct investments are notified by specific press notes or circular, but in the largest interest of the economy. And to give the boost to the economy, the new government, the new finance minister had put down few FDI, the foreign direct investment policy decisions and changes within the budget, so that he can do things, as soon as fast as possible, so that he just want to reach to the next stage and do something quickly, so that they can boost the investment, they can boost the confidence of the foreign investors. So let me take you through what are the key changes has been done in the FDI perspective for the foreign investor, which may affect them definitely. So FDI in defense manufacturing increased from 26 to 49% under the approval route. So henceforward, foreign investor can now invest up to 49% in the defense-related manufacturing activities with the prior approval of Reserve Bank of India and FIPB, the Foreign Investor Promotion Board. So you would need the approval, but now you can invest more. You would still need the Indian joint venture partner, but now you can invest from 26% to 49%. Similarly, they have done and they have increased the percentage increase in terms of insurance sector. So that has been increased from 26 to 49% again. Similarly, they have done in defense sector. Another FDI change, which was really welcome change, I would say, because there were a number of queries raised by the foreign investors who were already running manufacturing units in India, like manufacturing of products and goods in India, and there was an ambiguity that the foreign investors are not allowed to do multi-brand retail trading, or they were not allowed to do the e-commerce trading, which means they were not allowed to sell their products on internet, a platform which is all over the world you can do, right? That's the easiest way of shopping these days. So there is a welcome change. They have clarified that the FDI compliant manufacturing units who are the subsidiaries of a foreign company doing manufacturing of products in India, they are now allowed to sell those online on our internet platform, which is very good change, I would say. Another most important change which they have done in the foreign investment platform to boost the growth rate, to boost the smaller city development, is to specifically encourage the development of smaller cities and to make them as a smart cities. With respect to FDI in the township and construction development sector, they have they have reduced the condition which were earlier prescribed. So earlier it was said that you need to invest at least $10 million to become a part of the Indian real estate growth and invest your money into township development. You need 3 years to take away your money back. You need minimum area development for 50,000 square feet. What they have done, they have reduced the minimum investment to $5 million. They have reduced the minimum area development to 20,000 square feet, which means now you can go to smaller cities and you can take a smaller plot of area and you can develop that, and FDI money can be invested into that, and you can resell that after 3 years and take your money back, to be honest. And I personally feel that's a very welcome change, though I know that now the Indian real estate will again get some sort of boost, and if I have to go and buy a house, for me it may be expensive for me as well, because the FDI will come into India. So those were the few key changes which I would say which is there for the foreign investor. One more, I would say, take out myself from the foreign direct investment. The other welcome change for the foreign investors, or foreigner or expat, the employees of foreign companies traveling into India, the tourists who are traveling into India, is electronic visa. So they are gonna, it is proposed to implement the facility of electronic travel authorization, which we call as e-visa, to identified countries. They have not yet identified which country they're gonna give it to, but they're gonna do that e-visa. It will gonna implement it at 9 airports, and let's see which are the countries. And I would say UK and US would definitely be there. I hope so. So that was primarily the key changes in the regulatory reforms. When I talk about the FDI electronic visa, they have come up with few more other changes in the specifically which may affect the foreign investor. Is for example SEZ schemes, so special economic zones schemes, to be revived in order to turn it into an effective instrument to industrial production, economic growth, export promotion, employment generation. And they have identified few areas where they're gonna improve the SEZs, like in Kandla port and JNPT port. So SEZ, if I give a very brief background, it's like a special economic zone which is out of the Indian coastal waters. So you don't need to pay any export or import duties when you're trading with your goods. So it's like export of a country within a country which is sitting outside. One more regulatory change which may affect the companies, the foreign companies already having their subsidiaries or thinking to have their offices in India, is that Indian accounting standards. So Indian companies to adopt to new Indian or international recognized accounting standards in line with the IFRS, the International Financial Reporting Systems, is going to be in line with that. So implementation is recommended, voluntary from financial year 2015-16, and it will become mandatory for the Indian companies to do the international to relate to the international standards by 2016-17. So those were, I would say, the key changes in the regulatory reforms, Edward.
Okay, that's great. So, I mean, you obviously covered updates on a number of sectors there. Across the participants we've got joining the webinar today, we've got a number of universities. So, are there any updates on that sector? Have there been any changes?
Oh, absolutely. One of my favorite sector, education. So, they have, if I compare with the changes in the other sector, education has really got good amount of boost. So they have allocated good amount of monies for different schemes. So let me highlight few of them. For example, they have specifically said in the budget that initiative will be taken to provide the toilets, drinking water facilities in all girls' schools, teacher training programs to be introduced, innovative training and development tools for teachers, which is definitely the hour of the need. You know, when you grow your school, you need to have teachers who are trained teachers. So they have specifically said in the budget that there will be teacher training programs. $17 million allocated to create virtual classroom so that you can study from anywhere. $83 million allocated for development of 5 additional Indian Institute of Technologies, IITs. Another $83 million allocated to establish 4 new All India Institute for Medical Sciences, which supplies the education as well as the medical facilities to the poor of this country. 5 Indian Institute of Management to be set up, so IIMs, which will gonna definitely improve the management education in India. Simplify norms to facilitate education loans for higher studies. Proposal for 12 more government medical colleges with dental facilities are announced. So to be honest, right now I was advising to one of client who are into the dental facilities, and they are really happy to hear that the government is really getting serious about this specific norm. Huge amount, $788 million allocated for medical education and research. $17 million allocated for sports university in Manipur, and the big amount, and then I would say it's not the last, but it's to be honest, favorite amendment to personally, to be honest. They have allocated $1,667 million to further fund startup corporates, specifically in the education and other sector. But that's really a welcome change to allocate that much huge amount of money for startup companies. So it's definitely a very good amendment for the education sector.
Okay, and anything from a foreign education provider's perspective?
Sadly, no. So foreign education providers bill is still pending with the parliament, and we lost the momentum in last 6 months due to the new government, elections and all that. But I'm really positive that the new government will pick up, the new education minister will pick it up and try to get it passed from the parliament as soon as possible.
So watch this space. Okay, that's very useful, Kapil. So we'll come back to Kapil shortly. So we're now going to turn to Partho, and Partho, if you could take us through the direct tax proposals.
Yeah, thanks, Edwards. The direct tax proposal, before I get into, the challenges with this government, as we all know, it was and been discussed. It's a very 45 days government when it came in power. The government has to balance the demand or what the expectations of the corporates and the individuals. As a BDO, we have represented various chambers for the pre-budget memorandum, and we know that how much potential push is there from the corporates and the demands, and the fiscal deficit challenges the government has, so these are the challenges, the expectations. So the government has to balance both. And before I jump into the direct tax proposals, some of the key things I personally feel is the whole of the budget has, there are few things, key messages I would say is, there's a key thrust on the infrastructure. That's what the need of the hour is. Reduce litigations, tax litigations is at a very high. More clarity in the law, at the same time keep buoyancy in the revenue. These are the 4 or 5 key areas where within the short period the government has to turn out this proposal. Now let me jump into some of the corporate tax changes, which has got both clarificatory and some of the the changes what they want. Of course, any budget has some good news as well as some bad news. It's a combination of both here. So if any subsidiary in India for the foreign company the impact would be like it's paying a dividend. In India, you have a dividend distribution tax. So that would give another 3% extra on the tax. The way it is a clarificatory. The way the computation has been made now, the Indian subsidiary, when they're paying to any parent company on the dividend distribution tax, there is an additional tax payout is 3%. Not a good news. We move on to the another one is, there was when this Indian subsidiaries or the Indian parent receive dividend from the foreign subsidiaries or the foreign companies, there is a reduced rate of tax, which is 15%. It was supposed this was a sunset clause. However, the government has announced, and the finance minister made it very clearly that this reduced rate of dividend has made possible that a lot of collections, money coming into the economy of the country. So he has increased it, and there is no sunset clause, there is no time limit has been fixed so far for these things. And probably this would be a good idea, just so that the money comes back to the Indian economy and it does not stay out and reinvested somewhere else. So I would think this is a good for the economy of the country. Now, India has a very strict withholding tax regime in the past. It is going to remain strict even today, even in the proposals. But there are certain key proposals that has been made, which probably every corporates in India, every subsidiary companies in India has to be very abide by, because this has got a tax leakages, tax advantages, as well as tax disadvantage if you do not comply it in properly. See, if any payments where in withholding tax has to be made, if it has not been withholding tax has not been withheld, this payment is supposed to be disallowed by the revenue. However, now they have made a change in that, because there's a lot of pressure from the corporates because of the cash flow issues and everything. So they made it from 100% to 30%. That means only 30% will be disallowed. But this benefit has only been given to payment made to any resident. Suppose you're making a payment to a non-resident, you still need to comply with this entire withholding tax obligations. Then again, a good news for the non-resident, when we're making a payment to the withholding tax to a non-resident, this payment has to be made within the financial year, the withholding tax to be deposited to the revenue. However, that has been extended. It made par with the resident companies to make it during the filing of the tax return. Then, when you're taking an external commercial borrowings, so say if an Indian subsidiary taking an ECB from an overseas parent or overseas group company, there is a lower withholding tax of 5%, and the government said it will continue applying this 5%. And now that has been extended to the infrastructure bonds. So if an overseas company issues an infrastructure bonds, the 5% withholding, as a lower withholding tax, will still be applicable. Then we move to the, so there is again a clarification. This is something which has come up that, as I mentioned in my first point, that if certain payments tax has not been withheld, that expenditures will be disallowed. So they have made it widen this base that anything which is subject to withholding, any payment which is subject to withholding, has to be paid with taxes to be withheld. Thus, this includes now even the salary payments that we are making. And so while making, in the proper taxes to be withheld, otherwise that salary expenditure will not be allowed. 30% of that may be disallowed. So we have to be very, very careful while doing a salary structuring or the payroll structuring of a company. So we have to be very, very conservative in our approach. As I mentioned, as I started my remarks with that there is a thrust on the infrastructure. With that thing, the government has introduced two trusts. There is infrastructure investment trust and investment trust and a business trust concept. Basically, a trust is a pass-through entity which can hold the investments into the real estate properties, not the lands, but the developed properties as an inventory. This has got a lot of tax advantages. These tax advantages are it's like a pass-through entities to avoid a multiple cascading impact of the withholding tax for interest, for dividend, everything. However, they only have to pay on capital gain when they are selling off the properties they're holding it.
Perfect. Just to interrupt you on that then.
Sure.
So can a non-resident invest into a real estate investment trust?
Yeah, this concept of trust is actually developed by the SEBI regulation. There's a draft regulation by the SEBI. It's already in the public, and there is no restrictions as so far I recollect on resident or a non-resident on that. So that's a good news. Now I move on to capital gain. Again, there are some mix of good news and a bad news here also. So for foreign FIs, the foreign institutional investors, there's always a dispute whether the investment that they're making, whether it's a business profit or is it a capital gain. That has been clarified. It is now will be treated as a capital gain. The difference is there's a tax advantage of 10% straight away. Then the government securities, the government, in order to have popularity in the government securities in the overseas market, any transfer between the non-residents will not be subject to any tax in India, which is a very welcome move. Then the bad news is the debt funds, the mutual fund which is debt oriented, the tax rate will now be 20% instead of 10%, and the holding period has been reduced from 36 to 12 months. So this is where the mutual funds which are debt related probably will get into some problem. So that will put the money in the equity market, and which probably one of the objective maybe of the government to boost the equity markets. Now the government, as my friend Kapil says, the government has a lot of interest in development of the economy, looking at these things. So that has got some tax incentive as well. In the mid-size manufacturing companies, there is an accelerated additional rate of 10-15% has been provided if the investment is made within certain time period, and the investment amount is around 250 million Indian rupees. Again, an infrastructure related development incentives has been given to the power sector, both generations and distributions. The tax exemptions that is available to them has been extended to 31st of March 2017, which would probably give a life to the power distribution and generation companies. Last but not the least, some of the expectations of the individuals has been met, but not to the expectations what an individual like us would looking forward. But some of the points that they made, that investment linked deductions has raised from 100,000 to 150,000 rupees. Similarly, for any interest on the housing properties that you buy will go up from 150,000 to 200,000. So these are the small tax benefits has been given to the individuals. Then other point that under corporates there is an issue in the new company law mandates the corporates to spend compulsorily on a corporate social responsibility. We call it as a CSR. And this has come out in the new company law. There is certain criteria of who would invest. But there is a lot of confusions whether that compulsory investment of CSR would provide a tax exemption or not. Currently, it has been clarified in this budget. There is no tax exemption on this CSR. The definition of CSR and everything has been given in the company law recommendations in the company law bill. So that's there. That's one of the issues that they have, which all the corporates are still struggling on this thing. And my final point is the direct tax code, which all of us were expecting to come out in the public, which is there for the public for discussions for long. So much recommendation has been gone. Empowered committee has been formed. Their recommendation was also there, but still we have not seen, we have not heard anything from the new government, because the government said that they will still give a look to the new direct tax report. No clarity on the timelines yet, because there are a lot of way the tax that we work today is going to change once the direct tax code. So that's something that we were hoping keenly from the government to have some timeline to give the clarity to the corporates. Back to you, Edward.
Okay, great. So thanks for that, Partho. I can see a question that's come in already on CSR, but we'll hold on that for the time being. Come back to that. So we're now going to hand over to Abhinav, who's going to just take us through transfer pricing and structural reforms. Abhinav, over to you.
Thanks, Edward, and thanks, Partho, for your insights on direct tax proposals. It was very helpful. We continue talking about direct tax proposals right now, and I first begin with the key proposals of the transfer pricing. For our viewers who need to understand a bit more about transfer pricing, they specifically apply to related party transactions to assess and benchmark fair prices with a view to determine the taxability of transactions with associated enterprises. As an update, in recent times, transfer pricing has been a very, very hot topic amongst tax authorities in India, and more than 60% of pending cases reported right now are related to transfer pricing. We have almost billions of dollars of tax demand, that are currently stuck and pending before the courts. And I was just reading through some past reports that have suggested that India is the third highest jurisdiction with pending transfer pricing cases. So, in such a backdrop, it is imperative for the government to introduce some corrective measures and improve the transfer pricing situation in India, for lack of a better word. And one such change that we are going to discuss right now is relating to the advanced pricing agreements. This was a very, very significant move that was initiated by the previous government in 2012. That was the introduction of APAs, or advanced pricing agreements that we call them. Essentially, an APA is either a one-sided or a two-sided or a bilateral advance agreement between a taxpayer and tax authorities that helps determine transfer pricings for intercompany transactions and set standards that usually cover multiple future years. Through the APA, the tax authority then accepts not to look for transfer pricing adjustments as long as the taxpayers obey to the terms and conditions as agreed by the advanced pricing agreement. This is particularly relevant for entities like cost-plus entities, companies and software support services in India, or entering into unique transactions like royalty or fees for technical services with their related parties in India. And it has been helpful for them manifold. They offer better assurances on the transfer pricing methods. They ease out the risk of possible tax liabilities. They also decrease the incidence of double taxation and reduce cost links with audit, legal support, TP documentation, whatnot. However, till now, the APAs were an advance agreement, so to say, meaning that they would cover specified future years for which the agreement should be enforced. Though it was reasonably understood by all of us here that they would be helping mitigate TP transfer pricing liabilities for past cases, this understanding has actually now been codified under the law. There's a rollback feature that has been introduced, which allows the application of APAs for up to 4 previous years, provided facts and some circumstances of international transactions are similar. This feature would actually be effective from the 1st of October 2014, and we currently await some of the fine prints, on the applicability of such amendments to existing APAs and pipelines and some, administrative fine prints. This is definitely helpful for companies to avail this benefit. This helps rule out ambiguity and reduces litigation on transactions with their subsidiaries in India or their associated enterprises in India. The second change that I'm going to talk about is comparability analysis. The government has now proposed to introduce the range concept in transfer pricing, which is actually picked up from leading international practices all over the world. In India, actually, till now, the arm's length price was determined as the arithmetic mean of range of prices or range of margins. This led to a lot of uncertainty since no comparable enterprise can actually be similar to your own transaction, and moreover, there are limitations in the information available on comparables in the public domain. There are some comparability defects that remain irrespective of how much ever you go into details. The computing arithmetic mean as an average of, obviously gets distorted due to these difficulties and does not give a true picture. So introduction of a range concept is actually a step in the right direction, and this will also help reduce disputes at the audit and appellate levels for many companies. An added benefit as a corollary of the above is that the government has now allowed the use of multiple tiered data, which has been a feature actually that many taxpayers already availed in the past due to lack of data in the current year when they were entering into transactions. But this actually led to a lot of arguments at the stage of tax authorities when they were auditing or you are appealing against them in the higher courts because the law did not contain any provision as such. So codifying the range and the multiple year concept definitely helps taxpayers in reducing disputes before tax authorities going forward. Another small but impactful change is that there's an amendment in the definition of deeming transfer pricing provisions. This was actually existing only if an arrangement existed between independent parties who are non-residents. Now the scope has been enhanced to include residents in India. So this definitely impacts your transaction with parties such as intermediaries or global distributors, long-term service providers. The list is endless. So that's something that has to be changed. Now the next part that I am actually covering is the structural reforms. The first and the most important thing is actually retrospective taxation. This was something which was very, very well known to most of our viewers. It's a spillover effect of the Vodafone, Shell and other controversies by virtue of which the government introduces retrospective clarification to taxes transactions in India, and this triggered an international outrage among the foreign investor community. We actually, personally expected the government to get into aggressive gear on such retrospective amendments, and we expected them to either completely remove such provisions or provide some sort of relief to taxpayers who are currently facing the headwinds with cases pending in the courts. But our expectations actually fell a little short, with only a relief being provided for fresh cases arising out of this controversy. What the government has essentially proposed is to set up a high-level task force to look into fresh cases arising from such indirect transfers. They have to give an in-principle approval before initiating any action on behalf of the tax officer. While this is a welcome step, the extent of relief available is something that remains to be seen, especially when there has been no change in the law. I'll just quickly run through the other changes. They have proposed to strengthen up the advanced ruling and advanced pricing authorities. They've proposed to strengthen the settlement commissions, by adding additional officers, resources, and also introducing administrative reforms to speed up the process. I'm sorry, I think we lost audio for a moment. I was talking about setting up the strengthening the settlement commissions and strengthening the advanced pricing authorities. The advanced rulings have also been extended now to resident taxpayers, which is a welcome move for companies who seek to remove ambiguity on certain tax issues. The government has also proposed to set up committees to interact with corporate India at various levels, and therefore they seek their inputs on areas which concern them or require clarity from a taxability perspective. All these structural changes are definitely welcome, and they are a breath of fresh air, actually, to be very honest, in this era of uncertainty that was there with the previous government. This definitely sets forth
the intentions of the new government, that is to set up a tax-friendly environment for, ensure speedier processes, reduce litigation, but it's definitely a welcome move, but a lot more needs to be done. Back to you, Ed.
Okay, that's great. Anything that involves the expression fresh air, I think, is a good thing. So breath of fresh air is a good thing. So thanks for that. Right, we've got one final topic to dive into, and then we'll move on to Q&A. So I'll just hand on to Kapil, who's just going to spend a couple of minutes on indirect tax.
Thanks, Ed. Considering the short of time, let me straight away get into the topic. So I would say there are a few minor changes, but generally the rate for customs, excise, and service tax remain unchanged in this project. To start with, changes in the service tax, there has been removal of few services from negative list, and hence would now those services would be taxable. So, for example, sale of advertisement space, time on media platform, other than the sale of space in print media, where sale of space on TV and radio was already taxable in the previous, before the finance budget, but now the sale of space on internet and film. So if your Indian company is trying to buy a space for your advertisement, then service tax will be chargeable on that now onwards. Radio taxi services, so service tax is now applicable on that because that's been removed from the negative list. So next time you're in India, be watchful that the radio taxi guy is going to charge you the service tax on that total journey. So another change in very important change which has been for the education institution and education sector is primarily to look at that previously under the previous service tax regulation, the wider concession was provided to the education institution that when a vendor was providing some services to education institution, he was not supposed to charge services. But now they have reduced the wider concession. They have only made it limited to services like transportation of students, faculty, staff, security, house cleaning, or housekeeping, admission services. Only these services are exempt from service tax. The rest, any other services provided to education, Indian education institutes, is now taxable. So the vendors are not now supposed to charge service tax on that. The important other factor which has been now covered in the change in the phrase of provision of rules, which was earlier determined that whenever a service is provided, you need to determine whether the service recipient or service provider is located in India or outside India. So now what they have made the changes in the new regulation that they have amended the definition of intermediary who's arranging or facilitating the supply of goods and services. Now service tax will be charged on the services provided by the intermediary, which means such services provided by the buying house, the sourcing companies, the consignment agents may be under the plethora of service tax. So they need to watch out and take proper advice whether their services are now covered under service tax or not. Another important factor for the non-resident directors and expat directors who are providing some services to the Indian corporates. Now the Indian corporates is required to pay service tax under reverse charge mechanism on the services received from a foreign director who's sitting on the Indian board or providing some sort of services. Next topic, let me straight away get into taxes on goods. Those were more about taxes on services which are covered from service tax. So let me now come to key changes related to taxes on goods. There is increase in excise duty rates on tobacco, cigarettes, and few other related items. But as I said earlier, overall general rate of excise and customs duty remains same. Scope of excise duty on packaging, repacking, labeling on specified goods is widened now to include various goods and including packet software. So next time you're buying a packet software in India, there may be an additional charge on excise duty on it, which is actually passed on to the customer. There has been now the limit being defined for the sendware credits, which means 7 credits on input and input services could now be claimed only within 6 months of the vendor invoice date. Few structural reforms, so which was really awaited, that everybody was looking for. Is there any announcement how when government will come up with the GST, the goods and service tax law, which was announced by the previous government? So, but there is no timeline given under the finance budget for implementation of GST. But government has really proposed, the Indian Customs Single Window Project authority to smoothen the custom clearance process. which is really a welcome change to people who are importing and exporting goods out of India. And their servers, like one of our clients, was lying in the customs and for a number of weeks. So I hope this new authority will do something on that.
Good. Okay. Thanks, Kapil. So what we're going to do, we're now going to switch the video back on and run through a number of questions. So to start with, we're going to start with a poll question. So if you've been sat back listening, you now need to get back to your keyboard. So the poll question is, do the changes in the budget materially impact your plans or operations in India? So as you can see, there are a number of options there. Impacts in a big way, affects my business marginally, does not affect me, or I do not know yet. So if we can see the results of that. Here they come. Okay, I do not know yet at 75%, and it affects my business marginally at 25%. So, still some advice to be taken there to help the 75% get to understanding in detail. And we've got a couple of quite interesting questions which I suspect explain that. So the first question, which I'm going to direct at Kapil, is from Mr. Patel. Could you just clarify the situation on CSR activities? We intend to work with certain companies to deliver their CSR activities in India. I want to be sure that we're clear on the tax implications for our Indian subsidiary and our partners in India.
Very interesting question, I must say. So recently, they have the Indian government, the new government finance ministry, has defined and they have clarified, because there were a lot of questions raised. They have clarified that the CSR expense made by the corporate is not tax deductible. So they will not allow any CSR activities, money which you have spent on CSR activities, which is made compulsory for the corporates now, but that is not tax deductible. So your Indian subsidiary will not get any tax benefit on that. But of course, we have recently helped one of our UK foreign investor, UK foreign client to set up a subsidiary, and they are doing very good in terms of providing CSR activity. So we can connect Mr. Patel with one of our clients.
Okay, great. So the next one is on the topic of capital gains. So a question from Chris. So with capital gains and foreign investors, is there a suggestion that a UK company owning an Indian subsidiary could be subject to any Indian tax on the sale of the Indian subsidiary to another non-resident company? So, Partho, was that a question that you'd be able to answer?
Yeah, certainly. It's a very interesting question. Again, the government has, if you're selling the shares of the Indian subsidiary company and you're selling the shares to another non-resident, there's a two-way we can handle it. One, you are a non-resident and you are selling the shares to another non-resident. This is situation one. Situation two, you are a non-resident, you are selling it to the resident. So in the first case, there's a confusion that whether sell between the two non-residents, but the share is of the Indian company, whether it is subject to capital gain or not. So in this case, the government has clarified that if the Indian company has got substantial value in the value chain, what is substantial value? That's a different topic to discuss, but then it will be subject to capital gain in India, in situation one. So there is a subject to, there is some interpretation of substantial value. However, if you are selling it to resident Indian company, again the situation does not change much. It will be subject to capital gain.
Okay, great. So Chris, if you want a further discussion on that, obviously we're happy to do so. So the next question's from Linda. So maybe Abhinav, maybe you could take this one. So what is your take on the committee to review the retrospective tax position?
Not much to say there. Committee has been formed, but I don't really see some affirmative action on this. The law has changed. The committee has been formed. They're going to review all cases, but essentially, when the law is so watertight that it was when the 2012 amendments were introduced. They can't do much but accept those cases because they can't go against the law. What they might be able to do is sort of, sort the rubbish from the pile as to say that, okay, these cases are really not applicable to the retrospective amendments or indirect transfers in India, and they could sort them out and get them back on the board and saying that, this case is not relevant for us. But if the case is actually relevant, I don't see anything that the committee can do unless, they take a very hard stance that, we're not going to process any proposals or any cases which relate to indirect transfers. So unless there is change in the law, I don't see anything happening. Let's wait and watch for the next 6 to 8 months and how this committee is actually formed, what sort of powers do they have, and what sort of measures do they take to incorporate this case.
So for the future, there's reason to be positive, but for the existing cases, watch this space.
Yeah.
Okay. Good. Okay, we've got another question that's come in, which maybe I'll direct towards Kapil. So we're a UK company looking to enter the Indian construction industry as a service provider, surveying and project management. We're still unclear about A, our tax liabilities while working in India, and B, on the ability to return profits to the UK. So 2 questions rolled into one.
And definitely the most important question when I travel overseas in the UK and I simply get most of the time these questions. So let me try to just that into 1 minute. So the tax liability will be the corporate Indian tax liability. So when you run an Indian company, you're providing construction and project management services to other Indian corporates or individuals and your clients. So whatever profit you earn in India, you end up paying maximum 33% tax rate on whatever profit you earn. Now, how do you take profit out of India? That's a very tricky situation because there are few ways. One way is, for example, as we were talking, Parker was talking about, is to take profit out of India in a way of declaring dividend. But now the dividend distribution tax has actually increased from 17% to 20%. So that's not a tax efficient way of taking money out of India. So I would say that the best way is to take your profits out of India is either considering to sell some of your shares or buy back some shares of your Indian company maybe once a year, which is as per the new company law, you can only do once a year. If the Indian company buy back its shares, so you can take some money out of India. Or if you are considering as a sitting there in UK providing some sort of technical know-how or some sort of management services to Indian company, then you can charge or invoice from UK to the Indian company, and Indian company can pay you after withholding taxes, say 15% between India and UK, which are as per the India-UK double taxation avoidance agreement, and that 15% withholding tax, which is deducted in India, you can claim that back in UK while filing your UK tax return with SMRC. So that's one of the good route or tax efficient route, I would say, to take out profit out of India.
Okay, good and thorough answer there. Thank you. So the questions are coming in thick and fast. We've got literally 3 minutes left, so we'll squeeze in one last question. So the question relates to service tax. So Arthur, maybe if you could take this one. So with respect to applicability of service tax for service related to goods sale, will the service tax be applicable on commission incomes received from non-residents?
Okay, there's a service tax, there's a concept of place of residence and the place where you're getting the services done. If the services are done in India and you're importing service, that means you're doing it in India and you're raising an invoice, the service recipient may be a non-resident, but it is located in India and it's Sweden. Most likely it will not be considered an export of services, and this will be most likely it will be considered a taxable service in India.
Okay, great. So as I mentioned, we're kind of we're now there in terms of time. So thank you all for your participation. Thanks for all of the questions. So all unanswered questions we will make sure that we respond to over the next day or so. So expect an email in your inbox. I'd just like to thank the panel for their inputs this evening. And I do hope you'll join us again on the next webinar in our webinar series. So from Delhi this evening, thank you and good night.